Yeah. Hello everyone, welcome to today's portfolio update. I'll be sending out the schedule for October next week, so do stay tuned for that. We have a Meet the Investor session from Client Earth, and we also have another members sharing from Jiayi as well as Sept. Yeah, without further ado, let's get started with the first team. Is it just me or I can't hear you? Can the rest hear?
No.
It's okay. Maybe you want to try restarting. Maybe in that case, then we start off with team 2 first. Then Joseph, you can try and get your audio fixed. Team 2.
Yeah, sure. Yeah. Give us a moment. Yeah. Yeah, so yeah, I think we'll just do a quick one. So I think right now it's not a very good time for tech stocks in general. Sorry, let me on my camera. Yeah, it's not a very good time for tech stocks in general. I think this interest rate hike has probably lasted longer and increased even higher than most people were expected. So I think Meta is actually suffering from that. Just to highlight a few key news over the week so far. So I think first thing to note is that Meta suddenly has a lot of lawsuits happening. Okay, not really suddenly, but it was kind of in the coming for them. So I think previously we also covered a bit on the user privacy on iOS and Apple. So apparently they breached it. So that leads to a second class action lawsuit. So that's probably gonna cost quite a bit for them. On another news, they already have to pay another 140 million in terms of copying this patents from this walkie-talkie company. Not very bright for Meta as well. In terms of other news, they are looking to cut costs as well. So I think that's a bit of a problem because they are actually trying to cut down staff costs. Yeah, so based on firing people, which is not very good scientifically. But I think right now the company is going some form of restructuring. And I think they are trying to look forward into the future in terms of investing most of their retained earnings into the new project, which is the metaverse. Yeah, so aside from actually firing people, they have this 30-day list to find a new role. So they can either in the 1 month find a new role in the company or they leave the company. So it's quite a serious thing because they're trying to restructure the company a bit. But to be fair, they're not the only ones struggling with these issues. I think a lot of tech companies in the current space right now are also not doing too well. And actually looking to fire people. I think Alphabet is one of them, and a few others. Yeah. So I mean they have lost a bit of their value, but I think the way we look at it is that ultimately the skepticism is quite bad, but the fundamentals is pretty strong. Looking at it, I think they do have what it takes to sort of ride out this current situation. I mean, if you look at their fundamentals, it seems quite okay. I mean, I'm just looking at their ROE for now, but it seems like they are actually one of the higher ones already. And I think even though they return earnings pretty high, so even if they don't pay dividends, they're actually reinvesting all of it to the business and trying to incorporate it sort of like build up new sources of revenue for them. So I think that's a quite positive sign. And in the future it might be, and I think the debt holdings isn't as high as we hope also as we thought. So it's actually not a really terrible time for them. I mean right now I think it's just market skepticism. I think so far I think they still have quite strong fundamentals. So that's something to look forward to in the future. I think, but the metaverse again is a very huge gamble. I think people have compared him to being like Putin from Russia, because apparently he's like head in the sky and can't really figure out what is reality. So I think that's something to take note of. But aside from that, I think that's still one of the better position tech stocks around. And then yeah, so that's for Meta. So I think we're still gonna hold for now. And buy maybe not so. But hold is definitely there. Probably won't sell at the moment because we still have faith, even though it's little. But yes, faith is there. Grace, on anything before I move on to our potential stocks? I think she got nothing. Grace, are you there? Yeah, never mind. Okay, yeah. So in terms of potential stock, I didn't really have time to look at it. But we have been discussing, and I think we are really going forward with certain companies that we see that could potentially come out of this interest rate hikes as potential winners. I think right now currently it's quite doom and gloom, but I think we're looking at other companies like Coca-Cola, Pepsi, and Nestle. I think those are big conglomerates, and I think that they have the potential to actually ride out this and actually increase in value in the future, given that they're actually quite defensive stocks, even though it's not performing very well as a sector. We are still looking at that, and we will definitely look into the thesis, and hopefully we'll make an investment in the coming 1 or 2 and then present your next six stock pitch, I think. Yeah.
Thank you. Anyone have any questions for Team 2? Okay, then maybe I'll just ask one question. I'm actually quite curious, right? Because we are from the ESG program, so we care a lot more about ESG, right? And given that Meta doesn't seem to care about user privacy, what are your ESG justifications for still holding on to Meta?
I think for now, the justification is I think it's to look at it as a very long-term view. Given that yes, it's not a very good sign, it's not very nice to have a pending lawsuit from so many directions at once. I think it's because Meta has a very huge reliance on these platforms such as like the data privacy. I think that is really where they gain most of their revenue from at the current moment, and I don't think they can afford, given the current situation and their investments in the metaverse, to actually sort of like skirt around these privacy violations. I mean these violations, because they need the cash flow. Let's be very straightforward with that. I think they need the cash flow to actually continue building their business, and I think it is quite dumb of them to have done that, because this lawsuit could potentially cost more. But I understand where they're coming from, and I think it is just a matter of looking long term into the future, where if they can write out this storm, and then they probably won't need to be so desperate and like get like violate all these violations. Yeah, I understand it's not a very good ESG point of view, and they haven't done very much ESG good in the past few days, but as a business on its own, I think it's still quite it still provides value to the world, in that sense.
What do you think is the likelihood that they will violate such user privacy concerns again in the future?
In the future, I think this kind of companies, tech companies, typically this is gonna be a very sort of like high risk thing going on and on. I think for many companies, it's not something that is completely avoidable, especially in terms of Meta. So I would say maybe in the future, even if they own the metaverse space, I would say that's quite low, because that probably would drive the remaining of their revenues forward in the future. It's lower given that they own most of the sort of like data, the privacy there. But let's say that they'll work out, and let's say they continue to rely on their main traditional source of the income, then I would say the risk is much higher, because then again, who's to stop users of like Samsung or others to actually stop using that to actually create this data breach as well, these protections. So yeah, I think in the future probably we'll have to see where they head towards the direction.
Okay, thank you. Anyone else have questions? Okay, maybe we can move back to team 1. Joseph, you want to try if your audio is working?
Yeah, can you hear me now?
Yeah, yes, we can hear you.
Okay, great. Okay, just give me a moment. Yeah, can you guys see my screen?
Yes.
Yeah, okay. So maybe I'm just gonna kick things off, and our team will be basically presenting our initiation idea on Google. And maybe you guys want to just go ahead first.
All right. So Alphabet is the parent company of Google, which is the third largest tech company in the world. And its biggest market continues to be the US, that makes up 46% of its revenue, but it also has a presence in other regions like pretty much everywhere. And main business segments are Google Services, Google Cloud, and other bets, where Google Services is its biggest revenue driver, and core software products include Android, Chrome, Search, YouTube, and more. Hardware products are Google Pixel, Fitbit, among many others. And for Google Services, the core revenue streams are advertising and others, where advertising revenue can be further broken down into ads from Google Search, YouTube, and Google Network, with Google Search making up the highest proportion. So advertising revenue has been steadily, sorry, next slide. Okay, advertising revenue has been steadily increasing in previous years with acceleration in FY21. So growth in advertising revenues from Google Search can be attributed to greater search queries from growth in user adaptation and usage, while growth in YouTube ad revenue are from improvements in ad format and delivery. So Google operates a cost per click or cost per impression monetization model for its advertising revenue, of which it has significant pricing power. Advertisers using Google products can bid on search keywords such that their ads can show up to relevant end users in search results. They can employ different strategies like the cost per click bidding, where the advertisers pay when someone clicks on their ads. And the cost per impression model also charges advertisers for each impression displayed to users on Google Network. So from the chart on the right, we can see that the volume of paid clicks and impressions continue to be on an uptrend with positive year-on-year changes. Next slide, please. So with over 80% of revenue coming from ads, Google is the dominant player in the digital advertising market, holding over 23% of market share. And the market is expected to grow at a CAGR of 11% over the next 5 years, owed to the shift of purchases online accelerated by the COVID-19 pandemic. But consumers are also shifting away from general search sites like Google into sites like Amazon and TikTok. In North America, Amazon has been capturing a greater share of the search ad market, accounting for 19% in 2021 compared to Google's 57%. Despite this, we are optimistic about Google's growth and position as it continues to have under-monetized products like Google Maps, which only began allowing ads. YouTube is becoming a bigger source of its ad revenue, growing over 31% in FY21. So greater innovation like experimental features on YouTube have allowed it to identify products in videos and consolidate and boost YouTube's ARPU, which now stands at about 40 per year. Monthly active growth with premium subscribers at 50 million.
Yeah, so our first thesis is that Google still has dominance in the search engine space. Its usage has contributed to 80% of its revenue. So Google has been able to sustain 90% of global search traffic. So we believe that this provides Google data for their new initiatives like autonomous driving, artificial intelligence, and healthcare tech. Next.
Yeah, so going on to Google's subsidiaries, even though it only comprises of like 0.3% of Google, it is still something that as long as one of them succeed, it can be a huge revenue driver. And to show evidence, Waymo is a autonomous driving software on its own, and it is considered the market leader in that aspect, even over things like Tesla. And for example, like even for another subsidiary, Verily, their life sciences division that have even they not only have multiple products still in development, but they even have attracted big investors such as Temasek that raised about 800 million in the past few years. Yes. So next slide. Yeah. So the one of the biggest revenue drivers for Google is YouTube, and not only through YouTube Premium, but their development of YouTube Shorts, which is something quite similar to TikTok. So these short form videos have started to be monetized by YouTube, and one thing that YouTube has advantage over TikTok is that they have a better monetization package for their creators. And in this kind of creator economy, if you do not compensate them sufficiently enough, they are always going to go to the bigger platform, which is YouTube, which is what's the case if you have been on the social media platforms. And in relation with their YouTube Premium, that offers not only free YouTube music and also ad-free videos. The year-on-year growth was from 30 million premium subscribers to 50 million, which is quite a considerable increase, and it's a sign that YouTube monetization has been succeeding of their over 1+ or 2 billion free users. Yeah, and we'll move on to the risk next. Thank you.
So I will briefly brush through the risks. So the most probable financial risk in the short term is the slowdown of Google's advertisement revenue growth, because market research has shown that there's a general decline in marketing budget because the businesses are not very certain about the macro environment. And as for the ESG risks, like most tech companies, the problem is more coming from the social aspect. The first problem is the user privacy violation. So recently, South Korea has charged 50 million USD for Google for not clearly informing users and obtaining their consent while collecting and analyzing their behavioral information for better advertisement. So what they do is basically they set the default choice to agree while covering up further options available using the screen setting. So they try to be smart and work around this, but some of the regulators they don't recognize this. But let's face it, 50 million is actually not a lot for Google. And I think the more important issue would be the antitrust regulation. So basically, Google has this monopoly position in Android operating system on the smartphone and their dominance in the digital advertising market. So I think it's more serious because the lawsuit is filed in multiple countries and the size of the remedy is a lot larger. But I think Google offered to split part of its advertisement business into separate units under the company's umbrella. So we shall see whether this will work.
Okay, moving on lastly to the valuation. We use a probability weighted analysis to determine a fair value estimate of Google. So in our base case, we expect Google's top line to grow at a CAGR of 10% until 2026, while NPAT margin steadies at around 20%. So comparing against Google's historicals as well as sell-side estimates, our projections lean on the side of conservatism. Yeah, and in addition, we also assume 2026 expected ex-net cash PE of 25 times, which is lower than the historical 5-year median of 29.7 times. So yeah, despite these like more conservative inputs, our derived implied upside is still around 54%. Yeah, and if we can just take a look at the 5-year chart of the next 12-month PE, we are basically approaching, we are actually already below the COVID lows. And generally, the tech sector has sold off quite significantly. And thus, we feel that it is right to start having a non-zero allocation to the stock market. Yeah, and with that being said, we will be initiating a 10% position in Google over the next week. Yeah, thank you.
Thank you. This was very interesting. Anyone have any questions for Team 1?
Hey, Joseph. It's Shinya speaking.
Hi, Shinya.
So can you go back maybe 1 page or 2 page, the variations?
Yeah.
Can you explain one more time on revenue growth of 10% and then net income 20%?
Yeah, Shinya. I think it's just a very quick and dirty projection. So we basically just look at whatever the sell side was projecting, as well as looking back at the historicals, and also looking at the advertising industry entire CAGR until 2026. Yeah, so that was just how we derived like a very quick and dirty 10% revenue projection. And then for the net income margin, basically we look at the historicals, and
It's a margin. Okay.
yeah, for me, I just projected a 20% margin is really just because I think I think mentioned the risks, the ad revenue may come under some pressure in the short term, and so it's I think more wise to lean on the side of conservatism in our estimates. And so I mean, even though in 2021 NPAT margin was 29.5%, but if you look at 2017 to 2020, it was hovering somewhere around the 20% mark, and so we decided to put it at the 20% mark instead. Yeah.
Have you considered maybe breaking down into maybe advertisement revenues and also the cloud revenue? I think that will at some point it's going to be positive, right?
Yeah. I think that'll be good, but yeah, and we'll definitely look into doing that. Yeah, but it was really just of time constraint, and I think we thought that generally just looking at the valuations, it looked cheap, and yeah, so we didn't really want to like wait around anymore, and yeah, so we decided to initiate a starter position first, and we will continue to dive into the company. Yeah.
So I'm sorry. So what is the current PE?
The next 12-month PE is I think it's around 18 times. Yeah.
And you are expecting the exit PE at the 25?
Yeah, exit PE of 25 times.
So then implied upside isn't too little, 54%? Because you get 20% and then the revenue only grows 30%. No. How much? 50%, right?
Yeah, but yeah, it's around 40-ish. Yeah. Yeah. This is really a very conservative estimate compared to the sell side. Yeah, but yeah, we just try to lean more conservative, and I think our team kind of, especially during this kind of more like bear market, we really approach like this based on this like mantra that we have, which is like take care of your downside and the upside will take care of itself. So we really just wanted to make sure our downside is protected in a sense. Yeah, and we are comfortable holding for long duration.
But then everything is becoming cheap, right? And then why you want to be on the conservative side? Isn't this the time for you to take more risks? Because buying Google is probably not probably one of the most defensive way to get into the market.
Yeah, correct. I think our team is generally like still trying to be a bit more careful. I mean, we have held on to 100% cash until now, and we will only be initiating a position now. But I think in addition to that, I think just looking at the FANGMA or Manga stocks, I think we thought that Google is probably the strongest business model out of them all, and based on just like earnings multiples in terms of PE, it is among the cheapest already. Yeah, and that just really caps our downside. And I think in addition to that, the whole like passive investing kind of trend, generally like there will be more money flowing into the FANGMA stocks just because they are one of the largest constituents of the S&P and Nasdaq. Yeah, and so that will just help us to guide us in a general uptrend. Yeah, and we'll definitely look into like probably like further like riskier bets when the time comes. But yeah, for now we are just trying to play safe for now first. Yeah.
Got it. Okay. So hope you put more money into risky stuff before market goes up a lot.
Yeah,
Which
we
may not happen soon.
we were looking at China stuff, and yeah, it looks very cheap. But now it's like below 10 times PE or something. Yeah.
Yeah. All right. Sounds good. Thank you.
Yeah. Thanks, Shinya.
Yeah. Anyone else have questions? Yeah, if not, maybe we can move on to the next team, team 3.
Yeah, so this our team's portfolio update. I think it's a painful month for, I guess, everyone in general. Yeah, so just some macro updates. Yeah, so our overall portfolio is now down 8.6%. Mainly just macro updates. One specific company update for Adobe this time around. So I think generally it's basically a price movement is impacted by how the annual inflation rate remained very sticky, about 8.3% for August, which really beat like Wall Street expectations. I think consequently the FOMC also raised rates to the highest since 2008. I think more importantly, they also signaled very strongly at a sustained hawkishness in the meeting in the past week. So I think previously the median target federal funds rate was expected to peak by the end of this year between 4 and 5%. But now it's expected to peak in 2023 and possibly stagnate at 2024 before easing off, which really resulted in a heavy sell-off over the past week across all markets. Yeah, so now you see like all the major indexes basically dip below their year-to-date closing lows set in June previously. And that's affected basically all holdings for this month. Yeah. Yeah, so nothing fundamentally has changed for Darko, but I think we'll just dive into the some updates following earnings call for Adobe. Yeah.
Yeah, I can go through Adobe. So I think the key update for Adobe is that they actually announced that they will be acquiring Figma. So Figma was one of their key competitors when it comes to UX UI designing software. And the key competitive edge that Figma had over Adobe XD, which was their comparable product, was that Figma was a lot more collaborative. It was a web application similar to like how Google Docs versus Microsoft Word. Like Google Docs is basically like the collaborative version, right? So Figma actually was much more preferred in terms of collaborating online for UX and UI design. And the thing that is really controversial right now is that Adobe, at such a high interest rate environment, is actually offering a very high price to acquire Figma, which is $20 billion. So annual recurring revenue, sorry, of the typo there. So basically they announced that they will acquire at 20 billion, which is actually 50 times of the annual recurring revenue of Figma. So Figma's annual recurring revenue is around 400 million as of now. So a lot of people are very concerned about whether or not Adobe is just desperate and offering a ridiculous price now. And actually, if you look at the current cash and cash equivalents in Adobe's balance sheet, they only have around 3.8 billion. And they announced that they intend to basically spend half using cash and then the remaining half using stock. But even half of 20 billion is around 10 billion, which means that they really can't use all of their free cash flow to purchase Figma. So they actually intend to take on a term loan. So that's something that many of us are quite uncertain about. And that's also a reason why Adobe's stock price actually plummeted around 25%. And another concern that we have is that it's unclear whether regulators will actually allow the acquisition, because I think in previous tech company acquisitions, such as when Meta acquired Instagram and WhatsApp, regulators did actually come out and say that they were actually a bit regretful of allowing those kind of acquisitions. So it's unclear whether or not they will allow this acquisition to pass through. And another point is it is unclear also whether the upcoming macro environment and tech slowdown, as shared previously as well by the previous teams, for instance, decreasing budget for advertisements and all that, whether it will affect Figma's growth. Yeah, so I think that's generally the uncertainty around the announcement of this acquisition. But We were also wondering if there might be some insider information that Adobe knows of Figma that we're unsure of, given that they're willing to spend such a high price for Figma. And we also are aware that if you compare Figma and Adobe XD, right, Adobe XD was only generating around 17 million in revenue compared to Figma, which was 400 million. So I guess if you look at it that way, I guess the synergies and the amount, the large amount of difference in terms of revenue that Figma is generating compared to Adobe XD, maybe that makes it a more reasonable acquisition. But our team is unsure of the impact as of now. We still need more time to observe. But we feel that given that the stock price has already plummeted to so low, it's not a wise time to sell. Like we shouldn't sell at the lowest point, right? So we intend to hold, and then next month we'll reevaluate again whether we still intend to hold it or to sell it. And then I'll let Jia Yi to share a bit more about the Q3 2022 results. Jia Yi.
Okay, thanks, Pauline. So for this quarter, I think Adobe delivered like record earnings. So their revenue was 4.43 billion and it represents about 13% year-on-year growth. So the notable business segments are highlighted below. In terms of the digital media segment, there is a 13% year-on-year growth. And for the digital experience segment is 14% year-on-year growth. So we believe like some of the catalysts that still prove Adobe strong company to look at are definitely its strong earnings and also the expanding user base from the creators economy and also possibly generated from the new acquisition. The risk I think Pauline has mentioned just now and some of them which we have stated in the previous weeks as well as competitors and also the macro environment and also the possibility of the Figma acquisition eventually falling through. So these are something that we're still looking at and we'll give a more in-depth update in the next session. I'll pass my time to Sept to share more about GTS Holdings.
Actually, I think, GTS nothing much. So I think for company updates wise. So I think we just go through what's next for our team. I think in the coming week, we'll initiate a position in American Waterworks, which we presented the last time around, as well as add some more shares into buying some more shares of Darko, deploying another around $500 to it. So it's around the max cap which we kind of agree on as a team for an individual stock, which is at between 20 to 25%. And next, we also want to reevaluate the BTCs as mentioned and to come up with a revised target price and also a decision on whether to hold or sell the stock, right? But definitely not now or in the coming week, since like I guess the Figma acquisition, whether it goes through or not, yes, I guess the price is already priced in, right, by the market, regardless. And if our decision is to sell, maybe we'll sell it off a bounce. Short-term bounce, and to hold remaining 25% cash position. For our team.
So going back to Adobe, right? You don't consider buy as an option because the price went up so much. I think I hate this valuation, like 50 times ARR. It's just so high. This is like a valuation of probably a year and a half ago. Right. So I don't really understand why Adobe has to pay 50 times. But then have you tried? Has anyone used Figma?
I've used Figma before a few times. I use it for mockups for app development.
And then how was it? Was it useful?
It was useful, but a slightly steep learning curve for me. But I would say it's one of the best solutions for realistic looking app design.
Honestly, I think most people in our schools at least use Figma because Figma basically allows like you to use it for free at the start. Whereas like Adobe XD, like if you want to use it, you have to pay you straight away. So I also personally use Figma before, but I haven't tried Adobe XD. So our information is kind of like a research online, what people say about it. It seems like Figma is still a lot more popular.
Mm.
Yeah.
Maybe you can use and then see. Maybe there must be some, the very strong statistic reasons for Adobe to acquire this company. Right. And then the 20 billion, what is the market cap of Adobe right now? It's like 100 billion.
130 billion.
130. Yeah, so it's not a small acquisition, it's like 10%.
It's quite huge.
Yeah. Well, the price dropped, right? So they lost probably 50-60 billion dollars of the market cap already. But then maybe, yeah, I think I would love to hear, if there's any, the Adobe, Figma, the synergies. And maybe you can probably take a look at what the management believes.
Yeah.
Yeah. I don't think it's just a cost cutting. I don't think they will help the cutting cost. Anyway, Figma is losing money, so it doesn't make sense.
Yeah, I think we will look more into it because we were quite puzzled about it as well. But we were just wondering if there might be some reason that we just can't figure out. Like maybe Figma has a new innovation that we have not announced. It's like a secret weapon. I don't know. That was one of our wild guesses. Yeah.
Yeah, the question is, what is the segment products that Adobe couldn't create? Right. Anyway. And I like your Jinjae, your suggestion of maybe adding more money to Dacho. I like risk taking. Go.
Okay, I think our rationale is because Dacho is the only one with short to mid-term tailwinds still, and they're very strong cash position.
Right.
So yeah, I think a bit more to that.
Yeah. I think Sid, you wanted to briefly add something about GDS, right?
No, it's not much. I was just gonna say that GDS is planning to list in Singapore, and it doesn't have any clear financial impact for now from what we saw, but we were researching a few points, so we thought maybe they could be doing that to increase their image in the region. And plus, Singapore is the data hub center for Asia Pacific, so maybe they could be looking into something around that considerations. But it could also not go through, so it's pretty early.
Okay, understand. Okay. Yeah. Yeah, I think that's all from us. Anyone has any other questions? Okay. Yeah, I can tell from Shinya's questions that Shinya really wants us to take more risks. We will take that into consideration.
Oh yeah, you have too much cash. 50%? Well, everybody has too much cash.
Yeah, I think all of us generally are not very risk-taking.
Yeah, so it's been a year already, right? Or maybe at least a half the year since we opened accounts, and then probably more. So you only have one more year to go, right? And then don't worry, just take if you make a mistake, it's okay, right? And then take the positions if you think. Of course, I'm not saying that you should take the risk on whatever without thinking. But then if you think this is a the very good way to to take risk, and then after a lot of discussion thinking, and then I really encourage you to take risk and then see how portfolio behaves. And if it doesn't work out, then that's okay, right? If you to put more money on Dacho, maybe the probably the price will go down again, right? But then you can think, okay, why what went wrong? Right? What was the mistake? And you can think. So you don't lose anyway. Right? If you make money, you win. If you lose money and if you learn, then you win.
Okay, understand. Okay, then let's move on to our last team, team 4.
Can you hear me?
Yeah, we can hear you.
Can you see the screen as well?
Yes, we can.
Okay, so we will be covering 3 stocks: Intuitive Surgical, Unity, as well as Arco as well. So for the first one, Intuitive Surgical, we believe it's a hold at this moment. As you can see, some of the main points that kind of is into our concern would be some of the recent evidence of increased procedure use of these surgical robotics by Intuitive Surgical could have been due to COVID easing. So in a sense, this
can you make it a bit larger?
Oh, sorry. Is it better now?
Yeah.
So yeah, there's some evidence that these procedures, right, used by the use of this surgical robotics has increased in recent months due to easing of travel restrictions. As you know, like people go overseas just to do some procedures here and there. So this kind of might be inflated in nature, and in the third quarter, the numbers may not be as good due to the volatile COVID situation at the moment, and nobody can really predict what will happen in the future at this very moment. Other things would be there's also concerns about capital budget cuts, especially by hospitals in next year. So most people believe that hospitals will cut at around October next year in terms of their capital, and this could heavily impact Intuitive Surgical since their Da Vinci system is one of the most expensive but also advanced. So in a sense, to sum it up, all these macro headwinds kind of eats into our concern at this moment, and it's hard to kind of pinpoint like in a sense, if we enter a position now, it will be like catching a falling knife. So we don't want to do that right now, and we still want to monitor the macro environment at the moment. Then in terms of Unity, there's 3 things we want to point out as well in terms of our whole position. So in terms of its margins, similarly, economic headwinds. So through its guidance, it actually reduced its guidance recently, especially since it used its kind of like a proprietary machine learning system called Audience Pinpointer. So this Audience Pinpointer helped Unity decide that consumer behavior wasn't at the peak or optimal at this moment. So due to this leading indicator, they kind of expect their revenues to not be as strong as what they previously guided. So and in terms of our short and long-term view, I mean, similarly, in the short term, the economic situation is very volatile at this moment. And I mean, advertising is not in everybody's kind of back of mind at this moment, especially in an inflationary environment, and a lot of cost cutting is underway. But however, in the long term, we believe that there will be a shift towards the 3D world, especially in terms of the metaverse and whatnot. So as such, right, we believe that I mean, Unity's recent announcement that they want to acquire Iron Source instead of the AppLovin was actually a better way of doing things, as they are both kind of one of the best in their industries. And in a sense, their synergy will be creating this end-to-end platform. So Unity will be like the one running the back end of things, while Iron Iron Source will be the one helping with monetization as well as publication. And this is kind of help. This will help game publishers kind of have a ease of mind when they want to publish new games, so they don't have to go through too many loopholes and find new companies to publish with. And as for our third company, Taco, we believe it's a buy at this moment or relatively in the short-term future within this year. So there's a few things that we want to take note. The management did mention that poly prices were elevated at this moment. However, the demand is kind of high at this moment. And even at this moment, their capacity kind of maxed out. And I believe there's some restrictions to their capacity as well. However, this delayed capacity rollout is kind of industry-wide. So I wouldn't be too concerned, as it's not only a Taco problem, but I mean, it's an industry-wide problem. So it's a market factor at most. And the next thing to note would be quite interesting would be the share buyback that they announced in June 2022. So I think it's interesting that Taco's management is pretty confident to say that they believe that their ADRs are undervalued at this moment. So this gives confidence to us as investors that in the short-term future, they might buy back some shares. So we will be looking out for any subsequent drop in prices and slowly increase our positions as kind of, in a sense, if they kind of do a share buyback at the moment, this will kind of either kind of net out the effects of this drop, or you kind of give confidence to investors that the management are confident in their own business. Other things to take note would be Taco's consideration for a Hong Kong dual listing. So, I mean, the fact that they are considering this is also kind of points out the fact that they are very investor focused and they care a lot about their shareholders. So I believe, I mean, for our team, we believe that Taco could be a buy at this moment. Yeah, I think that's all for our team. Do you have any comments?
So, right, thank you. I also want to challenge a little bit about what you said. I'm sorry, what was the first company? Unity?
Oh, Intuitive Surgical.
No, Intuitive Surgical.
Yeah.
You mentioned that you're waiting for macro factors.
Yeah, correct.
Right.
Yeah.
And then it sounds like a little like an excuse of you are saying, well, you have no idea, you have no guts to buy. What exactly are you waiting? Because is a macro factor really important for this business?
No, as in I think I understand where you're coming from in terms of why we are so risk adverse. However, I would like to counter that we're just wanting to increase our margin of safety, like what Warren Buffett kind of preached. So in a sense, I mean, buying at a greater discount would be beneficial to us in terms of.
But then what kind of earnings you're talking about? Because everybody knows the macro will have an impact on this business, right? So what is not so sure? Because if they think of the macro factors, because are you trying to predict what's going to happen to the world?
That's the thing, because we need to understand how consumers might behave in this kind of volatile inflationary environment, and when recession might kick in, and some of this spending will kind of eat into the revenue as well in the short term. So there's no
right, but then if the recession hits, right, then Unity and Dacho both will go down as well. Right, everything will go down.
Correct, but Daco is really like more than 50% of what it is. So I believe, I mean, any further downtrend in its pricing will give its management kind of a share buyback opportunity. So this kind of gives me confidence as an investor. However, there's no such news from Intuitive Surgical. So I mean, that's where our concern is.
You're saying their share price is not cheap enough, or the company is not taking any initiative to revive the share price? Because it's different from what they, I don't know, I'm a little bit confused because because you don't know what's going to happen in the future,
Mhm.
right? So are you going to buy more if the recession deepens, or you're going to buy more if there's no recession?
In my view, I will buy more when there's a recession hitting. I mean, especially since in this climate, companies like Intuitive Surgical can't really push for more growth in this kind of environment, especially since, like what I mentioned, there might be capital budget cuts next year. So, I mean, there's no point to kind of rush, as they already know that their revenue aren't going to increase as much. So there's some kind of like a period where you can kind of decide when to go in. But I mean, I believe at this moment, both Intuitive Surgical and Unity is really quite cheap. But I believe there's still room for it to go down further.
But then that's maybe how much percentage? 10%, 15% you're waiting?
I mean, that's the thing. We're not very sure how many percent we're comfortable with at this moment for it to drop further.
Now, what's the target returns right now? Or maybe fair value of Intuitive?
I mean, conservatively, we are trying to target at least 50% since really dropped from it dropped tremendously. I mean, Unity is a similar case as well. It's dropped tremendously from its price in 2020.
Right, but then why are you waiting for another 10-15% drop? Because it's they attractive enough.
Yeah, but I mean, any more amount of margin of safety would be even more attractive.
Oh, that's true for any investment.
Yeah, I understand.
Right.
But I mean, there's no rush for growth stocks at this moment.
And then when you say there's more margin of safety is better, if there's a margin of safety, that's safe already.
Sorry, could you repeat the point?
If you said margin of safety, if there's enough margin of safety, right, that's the time you should get the positions, right? You should be more aggressive.
Yeah. I mean, it's not really I mean, our whole position is not a hold on its fundamentals. It's rather a hold on the timing issue.
So you want to trade in and out?
No, we're not
depending on
aiming
that
to trade.
performance. Okay. So you still think that the company is too expensive?
Yeah.
Given
well, I don't believe it's expensive. It's more of we believe there's still room for it to go down.
Yeah, but then that's true for anything, right? Maybe Google, we can say the same thing. Okay, right.
Yeah.
Let's see. Yeah.
Okay.
Yeah, that was a very exciting debate. Anyone else have questions for Team 4? Yeah, okay, then I think we will end off today's session. Yeah, the next portfolio update would be end of next month. I think it's 29th or 30th of October. Yeah. See y'all. Bye-bye.
Thank you. Good night. Thank you. Goodbye. Good night.